Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Jonathan Deyoe. How are you doing today, Jonathan?
Doing well, Kirk. How you doing?
Good. Well, those of you longtime listeners will know that Jonathan's been on the show before. I like his brand of financial advice, so wanted to have him back on. But for those of you who have not heard him before, Jonathan, tell us a bit about your background.
Yeah, so I've been an advisor for 25 years. I became an advisor right out of a graduate program in Buddhist studies, so sort of an odd path. And it took me until probably, I'd say, 8 years ago to really merge those two things together. I was always a little bit worried about, the financial services industry is kind of tough. It's very competitive, and I was always worried about naming my firm Mindfulness. So when I changed the name of the firm to Mindful Money, I was expecting a lot of pushback, a lot of, what are you doing? It's squishy. It's too soft. This is about finance. Da, da, da. I didn't get any of that. I'm in Berkeley, California. That kind of makes some sense, I guess. In 2021, my brother passed. So I ended up merging my firm into a larger firm. And so I kind of stepped down as a CEO. I have great management now. I love working at EP Wealth. It's great. I now just work with clients, and I focus most of my efforts on Mindful Money, which is more of an education and coaching platform for folks who don't have access to people like you and I in their regular lives.
Nice. So tell us about how mindfulness impacts investing, right? Because we talk about this to different degrees in the show, but tell us what it means to you.
So first of all, mindfulness is the non-judgmental awareness of the present moment as you experience it, right? And so one of the biggest challenges in investing is there's constant data flow. Stuff is flying at us every minute of every day. There's headlines, there's fears, markets do things, we react emotionally, and there's all of this stuff coming at us all the time. The problem, how that affects our investing, is it makes us feel like, and the media suggests that we should be making decisions all the time. We should, the Fed is doing a thing, we should react. The recession is coming, so we should do something. The problem is all of the efforts to be reactive to the headlines and to what's happening out in the economy ends up hurting our performance. And there's tons of research on this. Mindfulness allows us to sit still, attend to the knowledge that reacting doesn't work, return to, as we meditate, we return to our breath. In our finances, we return to our plan. And so we have a plan of investment, we've got a process for investing, and we just return to that process when things get agitating and scary.
You're right. I think what a lot of people don't realize is how much emotion actually plays into personal finance and investing. Maybe you can kind of walk us through some examples of that, because it's almost the entire experience of personal finance and investing. So maybe you can give us a few examples.
Easy. So I've been writing about this just right now. Right now, in the present moment, we have the potential of a hard landing or a soft landing, and that's every third headline. We have inflation that is kind of not under control, but a little bit under control, but we're not sure about how under control it is, and we're worried about maybe Fed raises rates again. We don't know what's going to happen there. We've got Russia and China, who are in basically a population decline, who have basically abdicated their places on the global stage and decided that they're going to go it alone. We've got Congress, who are just battling back and forth, and we're not getting anything done that we need to get done. We've got fiscal problems that are just crazy. So there's all of these things that are happening right now, and those headlines are there. And we are, if you look at anything about consumer sentiment right now, we're terrified. We don't know what's going to happen next. And you're seeing people hold cash, and you're seeing people call. I'm getting calls. Hey, Jonathan, should we be a little bit more conservative now? And so this reaction, if you think about it, will hurt us long term. It's not, if you make the decision to sell a beautifully diversified portfolio and go to cash and wait for an all clear signal, what you don't realize in that moment is you've got to make another decision. Like, when am I going to reinvest? And if you're making the decision in expectation of an all clear signal, that all clear signal never comes. Markets always advance before it feels good to invest. And it is the market's advance that makes us feel good about investing. And so it's getting ahead of it. And now, yes, Jonathan, there's all these things you talked about just now. I've been writing a lot about the year 1970. So people don't remember this, but in 1970, it was cataclysmic. It was terrifying. We had an 18-month, almost 40% bear market. We went off the gold standard, which is kind of like repealing gravity in financial sense. It's like saying, the world is going to keep spinning. We're going to repeal gravity and see if anything sticks to the world, right? We have no idea what's going to happen when we went off Bretton Woods. And then the third thing, and you may remember this, you may not remember this, Kent State. We had National Guardsmen go visit an Ohio school and open fire on students. So we had social unrest, we had massive global problems, and we're in the middle of a recession and a bear market. And guess what? Today we're like, I don't know the numbers offhand, but I think in 1970 the market, the S&P was at like 95. What are we at today? Like 4,300. Like, so that stuff goes away, but the enduring value of companies remains.
Yeah, it's interesting. We talk a lot about the 70s on the show.
Well, you do.
Yeah, we do. Because, well, if you think about the old paradigm, right? We were in a paradigm for the last 40 years, which is declining interest rates. And all of a sudden, a few years ago, interest rates started to rise, and now we're in a different paradigm. And the market hasn't realized this.
I know.
It's very odd. I mean, I guess it's not if you're used to 40 years and you're like, oh, well, I just do this and it equals that. And you have a whole generation of people who don't think, right? Because they're just accustomed to, well, if this happens, then this happens. And if this happens, this happens. We're like, what if I change this thing up here? Oh, don't worry about that. It's not important. I just know if this happens, this happens. And it's like, and so I think the whole market has just, I don't want to say lost their mind, but they're just not thinking.
Yeah.
They don't realize the impact of interest rates.
So in my professional life, I totally agree with you. I've been a sort of a value-based investor for a long time, and I've been wrong. And I know that I'm right now, but I'm waiting for the world to catch up with that. And I think that's kind of what you're reflecting on.
Yeah.
However, when I'm teaching people that are doing it themselves, I'm like, don't get into those weeds. Like you're never going to call those turns. You want to own the index and just own it all the time, whether that's a global index or a US index or whatever. You don't want to be in, out. You don't want to be thinking about inflation, and you don't want to think about interest, because you can't make calls based on that. Some people can. It's a very, very rare bird that can.
Yeah, that's definitely the interesting part of this is, most people, including Wall Street, are not thinking right now. I mean, there are some, and there are plenty of people who are thinking about this, but they're not. But like you said, it's hard to be ahead because you don't make decisions ahead of time. Sometimes you can. Like right now, you're getting paid 5.5% for taking virtually no risk versus investing in the market where there's tons of risk. This is the problem, right? You're getting five. Why are people not seeing this obvious investment opportunity? 5.5% virtually risk-free compared to, whatever the market's going to do. People aren't respecting that.
So this is gonna be a great conversation, because I totally disagree with you.
Okay, great. Let's do it.
So I
throw it down the gauntlet.
Let's do it. Let's do it. So yes, it's true. You can get 5.5%. But once you pay tax on that 5.5%, and that 500% is hurt by inflation, you're actually getting almost nothing. So the benefit of owning equities, and this isn't a sometimes thing. It's a commitment that one makes for a lifetime. And the benefit of owning equities for a lifetime, never getting out of them, never selling them, never second guessing this. The benefit is you get the average. You get that 9-10%. Yes, there's risk. Yes, it goes zig and zag. Yes, you have to do it right. You can't expect that from one company or 5 companies, but you can expect that from an index, from an entire economy, or especially from an entire global economy. You don't have to get into the picking and choosing. You do have to commit to owning it, even if it goes down 50%. So then people go, okay, Jonathan, you're saying everyone should own equities? And I just want to say, no, I'm not saying everyone should own 100% equities. I do. That's how I do it. I think that's the best way to go. But not everyone can sit through without reacting to a crazy 50, 58% decline. So you have to be prepared for that. I think it was actually Charlie Munger, who died 2 days ago, died yesterday, right?
Yep.
So Charlie Munger died yesterday. One of the things he said was, never interrupt compounding. Never interrupt compounding. And if you're going to compound, do you want to compound at that 8 or 9 or 10, or do you want to compound at that 5 or 6? I think, after inflation, it's 7 versus 3. You're always going to be better compounding at 8 or 9 or 10 than you will be at compounding 5.5. And it's an emotional thing to stick with it. And this is the challenge. This is why mindfulness comes into play. When the market goes down 58%, you have to remember that it recovers. You have to believe that it recovers. And then you have to hold on, not knowing when or how it will recover.
Okay, well, good. So you touched on a lot of points. Let me counter that. So let me ask you this quick question before we start. What was the best performing asset class from 1980 to 2010?
I know it's fixed income because of the declining interest rates. I know what you're saying. Yep.
Yeah. So the best performing asset class was 30-year zero coupon bonds by magnitudes, not a little bit, by magnitudes. And I think the point I'm making is that we are all accustomed to equities because equities have been performing great. It's what the newspapers talk about. Wall Street doesn't talk about bonds because they're boring. Who wants to be excited about a 30-year treasury at 15% for the next 30 years? That's not exciting. That's boring, right? It's exciting to me, but it's not exciting when you're not going to sell papers on that, right? Because the bond market, no one talks about the bond market, right? The Wall Street doesn't want people to know about the bond market. They're not interested. It's different. Equities, they love talking about equities. Oh, it's like, it's going to shoot to the moon or what everyone's dreaming about. It's what gets people excited. It's like the crack cocaine of Wall Street. It's like, hey, we get to talk about equities and how cool it's going to be. So I think there's an aspect of that which I totally agree with you. By the way, I think we're on the same page, but I think we're the nuances are where we need to clarify. Yes, it's important to buy and hold equities long term especially if you don't know what you're doing, right? If you don't know what you're doing, you shouldn't be getting in and out. That's probably the worst thing you can do. But I will say that the caveat that people in Wall Street don't talk about is that there are times that you should get in and there are times that you should not get in. Now, if you're sitting on a pile of cash and you're like, should I get in the market? And you're saying, well, yeah, of course, long term you'll be fine. I would argue absolutely not. Long term you won't be fine. It's like saying, well, should I buy into a stock that's got a PE of 5 or should I buy into a stock of a PE of 200? Well, if I buy into a stock of PE of 200, it's going to take me a long time to make a good rate of return on that investment. Whereas a stock of a PE of 5, I'm assuming they're the same stock for this example because there's other nuances there. But let's just say the same stock, you're getting a stock of PE of 5, I'm going to make a great return on that, like 15, 20%. That'll be awesome, right? But I think that the challenge is that we don't look at the valuation. We just say, oh, you just need to put your money in. So from January of 2000 till July of 2013, you would have lost money for over 13 years if you would just buy and hold. 13 years, you lost compounding because you bought in the S&P 500.
S&P 500. Okay.
Yeah, just a simple index. January of 2000 till July of 2013, the market was slightly negative for that entire period. It wasn't until the end of July of 2013 the market actually was positive, which means you lost compounding for 13 years. So the value of buying at the peak is that you're basically just eliminating time, which you can't make back. You can make more money, you can't make more time. So valuations are important, right? And this is my point. It's not that you shouldn't buy and hold. It's that there are times to buy and hold, and there are times to, in my opinion, you should look at other opportunities. If you're buying the most expensive market or one of the most expensive markets we ever had versus getting 5.5% risk-free, then I would argue that the opportunity set is clearly in the favor of low risk fixed income versus, in my opinion, high risk equities that are overvalued. At some point, they'll be cheap and it'll be a great opportunity to get in equities. And then you can hold it for as long as you want because you bought it. It's like buying Apple at $1 versus buying Apple at $100. If you bought it at $1, you're getting great returns right now. If you bought it at $100, less so.
So two things. One, yes, it's true that the PE ratio is high right now in the US specifically. So first, not suggesting everyone goes out and buys the S&P 500, right? I'm suggesting buy the global index because capital does move, and capital over the last 15, 20 years has come to the US, which drives up the price, relative to earnings in the US, but also drives down the price relative to earnings in international markets. So if you include things like emerging markets and international, which is basically been crapped on for the last 10 years, and everyone hates it. No one wants to invest it. And all the big money managers are saying, hey, why not invest a little bit international, right? Everyone's saying, hey, it's probably a good place to buy because it is really, really cheap right now. This is what it feels like to buy it really, really cheap. And maybe have a tilt towards in that direction. Again, for my clients, that's the kinds of things that we do. For individuals who are trying to pick and choose and do it themselves and don't have a lot of assets, and again, buy the global index. Don't overthink this, and hold on to it. Your asset allocation, the amount you should put in bonds versus stocks, that number, that percentage should be based on your plan. You should back into that number with your plan based on historical numbers. Don't try to pick valuation, because valuation is not a very good timing tool, and you know that valuation doesn't tell us anything. So the second part of that is, it's true that the PE ratio in the U.S. is high right now, but that can resolve in two ways, right? It can resolve with prices coming down, or it can resolve in earnings going up. And in 2000, you didn't know in 2000. In fact, the media in 2000 and the story in 2000, and maybe this is what you're saying, was it's a new paradigm. Like, this will never come down again. That's what they were saying in February of 2000, March of 2000. We figured out, oh, it does come down, right? So I don't think people are saying that now. There's a lot of people that aren't thinking it through. I totally agree with you there. But I don't think it's the same level of new paradigm talk that we had in 2000. So I think that companies, surprisingly, have been very profitable through this rise in interest rates, more so than I thought they were going to be able to do. They passed on way more inflation than I thought they were going to be able to do. And we're running pretty well there. So it might be, and I don't know, it's the future. I'm not forecasting. It's the future. It might be that the PE ratio resolves with the E going higher before the P comes down. And so if you don't get in, if you don't invest when you have that opportunity, you lose upside. And the reality is, no one has any facts about the future. And the long-term averages of equities versus a blended fixed income, you can cherry pick an equity that does much better, or an equity that does much worse. You can cherry pick a fixed income that does much better, or fixed income that does much worse. But the average bond versus the average stocks can outperform, right? That's why you want the 8s, 9s, and 10s instead of the 4s, 5s, and 6s.
Yeah, no, I mean, those are good points, and I like your point about global. And this gets back to the paradigm, right? We talked about there's a new paradigm going on, and part of that is the fact that Europe and Asia are not getting respected. Now, I could say more specifically, China deserves the lack of respect at the moment,
totally.
because their country's kind of in a bit of a challenge. But I will say, one of the big macro dynamics of changing of we used to outsource our inflation to China, especially in Asia, more generally, and now that's reshoring back here, or maybe more accurately, reshoring different places that are more expensive, which means that we're taking on more inflation, and people are, in my opinion, are tying that to money printing. But I would say we've been printing money for a long time, and it doesn't show the same inflation as we're having now. I think it's more of the deglobalization that's impacting things, and that's not going away. So I think we have to be acclimated to a higher rate of inflation. Now, when you made a comment about inflation impacting the returns, and I would argue it doesn't even make sense to look at inflation. Inflation's a constant. No matter what you're investing in, inflation's the same. So it's not a matter of whether inflation's going to impact bonds versus stocks. It's going to impact them the same.
Of course.
So I just remove inflation from the equation because it's a constant, right? Because it doesn't matter. So really what you're looking for is, what is the best risk to return trade-off? And yes, I mean, there is some preferential treatment to treasuries and munis over other fixed income and certainly equities, but certainly 5.5% is different from, well, I could make 15 or 20 in the stock market, which I think is probably more unrealistic in this day and age, but in short term it could. But the globalization part's interesting. If you look at Japan, it's so cheap and people are ignoring it. Now, of course, the currency is a problem too. So what I find fascinating about international investing, and Meb Faber has some good pieces on this, and how he talks about how the globalization, everybody's more focused on their own country, and they're country centric for where they live. But it's not just us. Everyone does the same thing. Like if you're in Japan, if you're in Europe, the same thing. But what's fascinating to me is Japan is so cheap and people are ignoring it. And I
Yeah.
have to assume it's all currency based because it's so cheap. And
Yeah.
they got some great companies over there.
There's great companies there. There's great companies in the emerging markets. We have brought so many of our investable dollars back to the U.S., which just pushes up our PE, which just it creates this opportunity. And if and this is something I'll say, if your advisor is saying, hey, right now we should take money out of international markets and put it in the U.S., your advisor's chasing return, and that's a mistake. That eventually, again, it's not a timing tool. You don't know when the transition is going to happen, but if I can buy, I think what is the average right now? If I can buy $1 worth of earnings in the emerging market for $10 compared to $1 worth of earnings in the US for $24, I want the dollars earnings in the emerging markets because I'm buying operating businesses. I'm not buying slips of paper that zig and zag in value on some kind of market. I'm buying operating businesses that create revenues and earnings and profits and pay dividends. And as long as I'm doing that, emerging markets are great. International is great. Japan's great. US is a bit expensive, but you can actually in the US, and this is, one of the things in the book is I include a list of the kind of ETFs or kind of funds that are broadly diversified that people might want to invest in, and on the list are dimensional and sort of value focused things. Now they're not perfect, but it is a way to get out of this S&P focus. Because if you just buy the S&P, 24% of your portfolio is going to be in 6 companies that are perhaps vastly overvalued, right? And so that's an issue. And so what do? Well, you find a different portfolio that broadens it out to maybe 5,000 companies and then tilts towards smaller cap companies that is going to tilt away from those much more aggressively priced companies.
Perhaps.
Perhaps.
You said
Yeah,
perhaps they're expensive. Perhaps. Yeah.
Perhaps. Well, the reality is they are growing their earnings. Like there is
Yes.
an anticipation of growing earnings. And if that happens, then everything I say about value is wrong.
Well, I think that's the challenge, right? Is that, when and everyone's looking at the S&P. I mean, retail investors look at the Dow because CNBC talks about the Dow because it's a bigger number, right?
Right.
Oh, it's a 1,000-point swing. Well, that's like 0.5%. Like it
Yeah,
doesn't
not a big
matter.
deal.
but the S&P is what more people look at, but it's gotten so skewed because of tech. But it gets into this reinforcement loop, right? Because you're investing in the S&P, it goes into the biggest companies most. Well, more shares in there, that boosts up those companies. I mean, you look at a company like Apple, it's had some negative news out in the last few quarters because it's a retail stock. I mean, people got to buy phones, but if you can't afford to put food on the table, you're not buying the newest, latest, greatest iPhone. You're buying an Android or something cheaper because you need a phone, but you don't need the best phone. And I think, this is where you brought in the 70s where things start to get a little bit weird, right? Is that you start to see the economists, which, bringing back my economics history, you bring back the idea of substitution, right?
Yep.
And instead of buying steak, you're buying hamburger. Instead of hamburger, you're buying Spam. So instead of buying the iPhone, you're buying an Android. Instead of Android, you're buying a flip phone or whatever. So I have to imagine that the positive reinforcement loop works in the reverse, right? At some point. I don't know when that is or when that starts, but it does bring up the fact that Wall Street is designed around certain things like indexing. And so maybe the S&P is not the best one, but what else do? Do you pick an equal weight index? I mean, you look at the S&P equal weight index and it's done nothing this year. I mean, it was negative for a decent part of the year. It's only in the last 2 weeks it's gone positive. And everyone thinks the S&P is doing great. And it's like, sort of.
It's an interesting question. It's like, and the way to teach this is say nobody knows what's coming up the next 6 months, next year, next 3 years, next 5 years, next 10 years. Nobody knows. It's impossible to know. There's no facts about the future. Okay, so if we know that, then the key is understanding that whatever portfolio you build, if you do equal weight, if you do S&P, if you use Russell 3000, if you do a dimensional thing that's got a value tilt with small cap in it, right? If whatever you buy, whatever you do, it will be tested. When it's tested, you have to hold on, because when it's tested, that's whatever it is, it will come back, right? It will ultimately get to that 8, 9, 10%, but it's going to get there in a different path. It's going to get there in a path that maybe they're not talking about in the media. Maybe they're not. So whatever it is when you're tested, You have to sit on your hands. If you sell it and buy something else that looks attractive at that point, the thing that's done well for the last 3 to 5 years, you're just going to revert to the mean again. You're going to be continually buying something that's high value and watching it go to lower value. Whereas you could be buying something that's lower value and watching it go to high value. So this is the thing that I talk about with clients, because we are separating it out into, small, medium, and large, and we're separating it out into growth and value, and we're separating it out into different geographies. But somebody that doesn't have the wherewithal to think about and the knowledge to manage that, to look at those risks, to see where the value is, and to seek value rather than price, that person much better off buying a global index probably, and just holding it. When they have money, add to it. When they need money, take money out of it, but don't make it complex. Like, don't make it complex. You'll end up 10, 15 years later in roughly the same place, maybe 30 years later in roughly the same place, but you won't be wrong all the time. And that's the risk of deciding. The risk is you're wrong.
Yeah, and you bring up value, and I'm value oriented as well, so I can appreciate your perspective. But I kind of look at value and say, well, value hasn't gotten respected in the last 20 years, and
Not at all.
Historically, growth and value have balanced. Generally speaking, they've gotten a similar return over time. Obviously, it depends when you're looking. If you're looking at the tech bubble peak, it's not. In the bust, it's the reverse. But over time, there's kind of a balance there. But in the last 20 years, growth has taken off and value has suffered. And it's not because it's doing poorly, because they're just doing less well. So fewer people are interested. So it kind of puts it in this negative feedback loop of value's out of favor. We're never investing in value again. And you also have the fact of, you look at like 2008, when you had the crisis and these value managers were buying deep value, which was basically WAMU, Countrywide, and all these other deep value stocks. And for those of you who are listening, I'm using air quotes to call it deep value. It's basically junk, but it was quote unquote cheap at the time. And so it kind of brings in this aspect of, if we repeat the 70s in a meaningful way, you're going to have a similar outcome of some companies that formerly were thought of as okay now turn into junk. And what is value actually versus, what's good investing versus, quote unquote, deep value.
Yeah. I mean, I think that the way Dimensional answers that is by blending it with quality metrics at the same time. So it's having a low price, but also having profitability. Like, it's blending those two things together. And it's true that, and this is, I think the next 3 or 4 years, we're going to see this, rates have gone up substantially. There's a whole lot of companies that are going to have to refinance debt. As they refinance debt, that means their interest payments are going to be higher, which means their profitability is going to be lower. And so those kind of things are going to happen. And then how will that affect those companies? And then more importantly, how will that affect the people invest in those companies? Will they get scared about those things and go to other things? These are things we don't know. Again, no facts about the future. And every advisor is going to have to manage that for their clients. Again, for people that are just doing it themselves, the thing you have to work on is you have to work on mindfully holding when it gets difficult, because it will get difficult. No matter what you build, it will be difficult at some point, whether it's next year or 10 years from now.
So using that, what do you think about the value of having cash in a portfolio when the market's expensive?
Yeah, I go back and forth, and I go back and forth based on when I wish I had a cash, right? So there's moment I'm fully invested. When I have cash that comes in, personally, I have cash that comes in, I invest it right away. I don't think about it. I just invest it. And then there's times when there's a market dislocation, and I would like to take advantage of that, but I don't have any cash. So I think the person that's been the best at this has been Warren Buffett, who builds, hundreds of billions of dollars of cash and treasuries, and he holds it, he holds it, he holds it. Markets collapse, he invests it, and that's brilliant, and that works absolutely. He has the benefit of an ultra long time horizon. I don't know how that affects or how good people are at doing that themselves that aren't Warren Buffett, and that's, there's a guy, Paul Merriman. I don't know if you've ever had him on the show. He is deep value, small cap value. He suggests it all the time. He believes in it. He and I had this conversation. I'm like, Paul, you're absolutely right. In intellect, you are correct. In application, I don't know if people can do it. I don't know if people can actually hold cash and then invest at the right time. And that's that's the thing I go back to, is the research says that people who try to time markets, who try to be strategic, who try to be tactical, fail relative to the market long term. So just own the market. I mean, keep trying. You're a professional. I'm a professional. I'm going to keep trying. You're going to keep trying. Others are going to keep trying. But if you're just a person who's got a family, who's got a little bit of money on the side, is trying to invest, don't do that. Don't try it. Just buy the global index, hold the global index. Don't get cute with it, because you will hurt yourself.
Yeah, I mean, I agree. I think the average investor, it's not a good strategy, right? And we talk about we talk about the value of cash in the show. Not that everyone should go out and sit on cash, but the fact that you should understand the aspect of it, right? If you're 100% in cash in 2008 and the market goes down 50%, your cash went up 100% in terms of buying
Buying
value, right? So that's how I look at it. Say I just made 100% on my cash because I can buy twice as much stuff. And people don't look at it that way because it doesn't show up in their statement that way. But it will if you buy it when it's 50% off.
And the challenge is, if you were 100%, did you commit 100% of your cash in 2008 when everything fell apart? And I think many people will say no, because most people that have a bunch of cash, when I call them, they're sitting on $300,000 of cash. When I call them and say, hey, now's the time to invest, they'll be like, oh, I'm really scared right now. I don't want to invest it right now. Can we wait just a month to see what happens? And that's that month that counts, right? And that's the challenge, is the behavioral bias, the cognitive biases take over in emotional periods.
Well, I think you're right, and it's really, if somebody was all cash and they bought at the bottom, they're probably a liar, because I remember the bottom. We had a large amount of cash throughout 2008, and we wrote it out. But then 2009 in March came. I remember that period. Like, me and my partner look at each other like, I'm thinking of buying Citigroup at $1. And I was like, why don't we look at the options? Like, the options are more than $1. Like, the stock's cheaper. You can buy the stock cheaper than you can buy the options. Like, it was just, we live in this like Alice in Wonderland world at the time. But I remember vividly, because I was looking at him like, God, this is so cheap. We just dump all our money in. Like, it's just so ridiculously cheap. And this was like a day away from the bottom. But I'm only reflecting on it because I remember emotionally where my head was. And I remember thinking, like, any day the world could end. That's where we were, right? The banks, you didn't know what banks were safe, which banks weren't. You were putting money in treasuries because you didn't know which bank was going to go under. And you didn't know if the stock market's going to go down. Like, it had gone down so much. It had gone down 58%, I think, at that point, 58.6, I think, percent from top to bottom. And yet at the same time, you weren't worried about making money. You're worried about, like, is my cash safe?
Yep.
It was a crazy time. And
financials were down even more. I mean, the banks were down even more. And that's like 75%, 80%. And that's like, do you buy a bank at that point? I mean, how do you get out of your own way to do that? It's so hard.
And you raise a good point, because like I said, my business partner, he bought some Citigroup because he's like, whatever, it's $1. What's the worst I can do? And I look at it and be like, yeah, I get that. And there's a certain level of risk you have to take. You have to just say, I'm just going to hold my nose and buy, right? Because at the bottom, you think about 2020, right? In the bottom of 2020, when things were really scary, think of the time frame we were at. This gets back into the mindfulness. We're wrapping it back into your concept. So the mindfulness at the time was, hey, we're in a good position. We got some cash. We could buy it, but the whole world is shut down. The global economy has gone to a standstill, and yet we're only down 30%. like it's obviously it's going down more, right? And so it gets into this like mindfulness of like, how are you thinking at the time? And I remember thinking, like, there's some obvious plays that had nothing to do with the global market and the financials that were okay, but generally speaking, like, we're only down 30. Like, we should be down 50 or 60. If this stays, the whole global economy should be shut down. Then we should be into the stone ages of stock prices. And yet it didn't happen, because the Fed came in and said, oh, we're going to buy everything that's not nailed down, and they bailed everybody out. But I think the mindfulness is really important, like you're pointing out. And so how can people put themselves in a stronger position in moments like this, if they are fortunate enough to have cash and are smart enough to just say, I'm going to have some on the sideline? Like, how can they manage this in moments like that?
But I think that there's two things. There's two parts to this. The first part is actually being mindful, and actually having a mindfulness practice, and actually sitting on a cushion and staring at a wall 10 minutes a day. I actually think that's really, really important. because that is what enables your brain to step in, your frontal cortex to step in when your amygdala gets crazy, right? Without that, you're subject to your emotions when things get rough. But the second part, and it's not enough to just have mindfulness. You also have to know the process, right? It's not about investing. Successful investing is not about a market outlook. It's not about picking the right market outlook or picking somebody who has the right market outlook. It's about having a process. And when you're mindful and that emotion occurs, the markets collapse, there's a pandemic, there's a great recession, whatever. When you're mindful, you return to your process. You return, just like when you're meditating, you return to your breath or whatever your anchor point is. When you're worried about the global financial system, you return to your process. What did my process suggest that I do? Our process in 2020, and actually this is just a part of our process, is when elements of the portfolio drop by 20%, we begin to look at rebalancing. So in 2020, one of the things we saw was, equities collapsed, bonds did pretty well. Different than 2008. In 2008, everything went down. That was rough, right? So you didn't have a really good rebalancing opportunity. In 2020, we had a fantastic rebalancing opportunity. Bonds went up, stocks went down, and so when the market went down 20%, we didn't hit the 20% mark because it was moving really quick. We didn't hit the 30% mark because it was moving really quick. About 25%, we did a rebalance. So we took a chunk of bonds, sold them, bought a chunk of stock. And it's just our process is when markets decline 20% or more, we start looking at building out a rebalance. Simple as that. It's just that. It's a trigger point rebalance. You can look it up on an Investopedia to see how it's done.
That's a great tactic. I appreciate you sharing with us, Jonathan. So as we're getting close to wrapping it up here, any final thoughts you want to leave our listeners with before we wrap it up?
I share the same final thoughts all the time when people ask. Stop predicting, start planning, and stay mindful.
Nice. Well, I appreciate that. Where can people find more about you? And you have a new book out too. You want to tell our listeners about that?
Yeah, it's Mindful Investing. And that may be actually a mirrored, so you might have looked wrong, but it's okay. Mindful Investing, it's available at Amazon. It's available all over the place. Definitely check it out at your local bookstore. It just talks about how to invest in the easiest way possible for people that don't have access to advisors. And then the place to find us is at mindful.money. That's where all the coaching and all the classes and the courses and the memberships and stuff are.
Awesome. Well, Jonathan, once again, appreciate you coming on the show. Always enjoy having you as a guest and our conversations as well. I'll put that in the show notes for all listeners. And thanks again for coming. And we'll probably have you back on in the future, especially if you ever write another book.
I'm working on it. Thanks, Kirk. It's been great.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute. But before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right, that was a great interview with Jonathan. Really appreciate him coming on the show again. Always appreciate his insights. And we don't have enough people who promote mindfulness. And I think when it comes to investing, it's one of those areas that people think is kind of this fluffy area. But I can tell you that if you look at the top hedge fund managers, they're all looking to be more mindful. Most of them are using meditation. All of that stuff that we kind of generally look at as like, it's a little flimsy. I could tell you if the best and brightest are doing it, you should probably look at it too. So anyway, now we're into the panel portion of the show where you have our very own Barb Friedberg. Hey, Barb.
Hi, happy to be here. Happy 2024.
Yeah, happy New Year to you too. We also have our very own Doug Heagren. Hey, Doug.
Good morning, Kirk. Hey, Paul. I'm sorry, Paul Bunyan, swinging the axe out with 2023 into 2024.
Thank you, Doug. Yes, my kids call this the lumberjack shirt, and I agree. This is the Christmas time. Let's wear an ugly shirt time, and I just kind of started to like it and just took it off. So, all right, well, let's get off the Paul Bunyan and get into the interview. So, Barb, what were some of your takeaways from the interview?
Well, before we get into that, I would like to say that I'm happy that we are all color coordinated today, because I believe that's very important. So back to the show. My takeaways were that your mind can be your biggest enemy in investing. And even the most successful, seasoned professional investors have trouble sticking to a plan.
Yeah, no, I would agree with that. I think, as we kind of dive into this interview, having a plan is one of the most important things you could have to fight your baser instincts as human beings, which is one of the hardest parts about investing. Doug, what about you? What are some of your takeaways or points you think are relevant?
Well, I think to second on what Barb just said, I mean, we talked about this, Kirk. I mean, how many times do you see it when the markets are at the most dire, that's when you start to see people unloading their stock, right? And then when the markets are at the most, the most positive, that's when people start buying in. There's the emotion. It is very hard to make decisions when you apply emotion into it. We see that right now with with the way you hear advice on, FinTwit and from everywhere, from all the talking heads. I heard just the other day that Jim Cramer, take it as a grain of salt, right? Jim Cramer was basically has been completely against Bitcoin, right, for a long time. Now all of a sudden Bitcoin's continued to hit some new valuations, and he just came out the other day and he's like, now I'm a firm, I believe in it. I think it's got teeth, right? It's like, well, and maybe it will. Maybe it'll continue to grow. Or maybe he's jumping into it now that it's all of a sudden got to the point where it's expensive. We don't know what's going to happen. We listen to people who give advice around what to do with investing, or we talk about real estate, give advice about real estate. How, there's data out there that tells you certain patterns. It tells you to be prepared for risk. It tells you to watch, but yet people will allow emotions. They'll allow biases and things like that to control the decision-making and convince them now is a good time to make this move, or now is not a good time to make this move. And I think that, again, this all comes back to emotion. And I think I saw the other thing, I'll leave it with this. I saw the other day, just last week, I saw a chart that showed that the fear index, there's an index out there people track, greed versus fear. It was at the most extreme of greed. And this was a week ago. Now what happened? Now we started New Year's, right? And in just 2-3 days, it went from the most greed down to the most fear in 3 days, right? So it just, and again, that is going to dictate, and we see in the sell-off that's going on, that's going to dictate, and what happens in that situation is, unfortunately, you get out of your discipline, you start to react to what has already happened. And that puts you in a situation of very often being a day late and a dollar short. Okay. Whereas you would have been better if you would stick to the discipline. And this doesn't just happen in the stock markets. This happens in decision making and planning all the time, in the things that people say that they want to do. It's one of the reasons that risk tolerances, surveys are so difficult to manage, because so what would you do in this situation? Well, if I don't have that pressure, it's easy to say what I would do. But how many times, and not just the two of you that I'm talking to, but those that are listening to this, how many times have you go back and think about when that actually occurred? What did you do? And I would venture to guess more often than not, it wasn't what you said you were going to do, which unfortunately makes it very difficult to make those types of allocation decisions and make them static, because humans are irrational. It is what it is.
Well, I think we can agree on one thing, Doug, that Jim Cramer is a good contrarian indicator. Anything he says, do the opposite.
But there's a lot of people, you should have read the comments from that. So are you saying that Cramer is now pro inverse Cramer? Because there's an inverse Cramer tracker out there, by the way.
Yes. That was going to be my next point. That's Alice in Wonderland. Jim Cramer is positive on the inverse Jim Cramer. All right. Well, let's dive into it. So, Barb, so what are some strategies? We're into the new year. We're into 2024, and obviously, things are well. This is actually, we're recording on January 3rd, so the year hasn't started. We had 2 days in the market, so we don't really have a trend yet. But I would imagine this year is going to be a little different from last year. So what should people be thinking? Like, what general rules of thumb should people be using in a year like this, where we might have a bad year this year after a great last year? Things might be not so good. So what do you think? How should people be thinking about the psychological aspects of investing this year?
If you are investing in the financial market, stocks and bonds, ETFs, you have to know a couple of things first. You need to know that stocks typically will give you higher returns over the long term. That doesn't mean over 5 or 6 years. That means over decades. The average stock market return since 1927, which is roughly 100 years, is about 9%. But within that 100 years, we've had years where the average stock market index has fallen 30 or 40%. That is a lot. And unless you can handle a 30 or 40% drop in the stock market in 1 year without selling, you should not be in 100% stocks. And that's why almost all professional financial people suggest having a balanced portfolio, including some bonds, including some cash, because although their historical returns are lower, bonds have averaged about 5%, cash about 2 or 3%. When the stock market falls 40%, your bonds might go up, they might hold stable. If they do fall like they did in 2022, which was a rare event, they will not typically fall as much as the stock market. And cash, the only thing you're going to lose from cash is purchasing power due to inflation. Summary: think about the mix of stocks, or the percentages of stocks, bonds, and cash you want to hold for this stage of your life, so that you can enjoy the upside when stock market returns go up, but you also have a little cushion or a ballast when they go down, and your bonds and your cash will hopefully hold up the returns of your overall portfolio.
Yeah, that's great, Barb. So, Doug, what about you? What are some of your thoughts on how people can be more mindful this year, given that this year is probably going to be very different from last year?
Well, just in the last couple of days, we've already started to see a little bit of that 2022 correlation occur again, which is interesting with the treasuries. Like you were saying, historically, bonds or fixed income, especially treasuries, have been what we call reverse correlated, What that means is they will tend to underperform when stocks overperform, and then stocks will, when stocks underperform, they will, the treasuries or bonds will overperform. And what that does is that smooths out that volatility, right? And it's going to give up some upside for hopefully some benefit of the downside. And that does not always work. And over the last 2 to 3 years, especially, as often, Kirk and I have talked about this before, stocks are an emotional decision. It's like, what do I think it's going to do? Is the world going to be excited about that? Do I think that that's going to be enough to make people want to pay more with the supply and demand? Fixed income tends to be more mathematical. Whatever interest rates are has a direct and relatively easy to calculate impact on the valuation of fixed income, especially on the secondary market, which is what everybody listening to this pretty much works with. It's where you can trade versus an IPO, which is when it first gets released out to the public. So with that being the case, 2022. We did not see reverse correlation. We saw complete correlation, and we saw treasuries, because it was the catalyst for the decline of the markets was the raising of interest rates. We saw treasury stock, bonds drop in value, which mathematically could be predicted based off of rising interest rates. But we also saw equities debt. Now, last year we saw an uptick in the stock market significantly for the most part. And we also saw a rise in treasuries during the same time. There was a correlation, although albeit not quite as much of a correlation. To start this year, over the last couple of days, as the stock market has fallen to start the new year, treasuries have not held up. They've dropped again as well. So for 3 years now, we're seeing this, a correlation between at least what most people think of when they throw in bonds. They think of treasuries historically, although there's many different kinds. You've got, bank notes, you've got corporate bonds, you've got, municipal bonds, et cetera. But when we think of the general predominant asset inside of, say, an aggregate bond fund is going to be treasuries. And we have seen they've not only are they not reverse correlated anymore, I can almost argue they're not even non-correlated, which is not a bad thing. Gold typically is non-correlated. And what that means is, there's no pattern, right? Stocks go up, gold's going to do its own thing. Sometimes that's up, sometimes that's down, sometimes it's sideways. Non-correlated is a good thing to have in a portfolio along with reverse correlated, because a non-correlated isn't always going to be giving up something to get, to have something else. The problem is that, again, they say this time it's changed. Well, in a way it has, because what is impacting everything right now is interest rate pressure. Okay? And it has to do with decisions based on the Treasury, which, again, doesn't necessarily have a direct correlation to the stock market. The stock market, again, is opinion-based. It's going to be, what do I think the impact of this is going to be towards these companies, these stocks? But it is, again, a direct correlation to what goes on in bonds. So as long as these interest rates are getting marked around, they have a much stronger impact on bonds than almost any other type of advice that comes out. So what does that lead for the new year? Now, I think it leads to something that, is something people are going to have to be aware of. And again, it's almost too late, but yet this could continue, is do not think that you are making your portfolio safer with bonds. And that's been something that has been preached for many years. I had Representative Fidelity come and talk to a group of us, an FPA group of us years ago. And this is probably going back a decade. And at that time, what he said is he started to say, this representative, don't assume fixed income is going to be a safety net. The SEC started coming out with that a couple of years later, saying, be careful, bonds are not a safety net. And again, 2022, it proved bonds are not a safety net, right? And so that in that relation, he actually started to say that I think more people should use immediate annuities as part of their portfolio. And of course, the whole room of investment managers went, what? And they groaned, right? Because a lot of them are investment managers. He said, no, hear me out on this. I'm with Morningstar. It does me no good to talk about annuities. Okay. We do investment research, But he said, what is the point of fixed income in a portfolio? It's really the income, right? It's the interest rate you're getting off of it. And he goes, so think about it. If the volatility of fixed income comes into play, it will degrade the benefit of that income, because the point of the income, and when you go into retirement planning, I've talked about this before, the farm analogy, you really want to have, especially for those of you transitioning into distribution, it is much more difficult for you to deal with volatility, especially early in your retirement, if you're going to need to go and liquidate those assets in order to create your income. I tell people when I talk to them, when you're working, you're not paying for anything. You don't pay for a thing. Of course, I get the glare. What do you mean by that? I pay for everything. No, whoever you're working for pays for it. They give you money. That money gets funneled to other things. Some people are able to funnel enough or less than that. And a lot of people, hence the debt problem, funnel more than they make, right? It's when you go into retirement, it's the first time you're going to be paying for stuff yourself. That's why you build up your collective assets, and you've got to figure out how to turn that into an income stream. And if you are relying on those assets and they're all invested in the market, and you think that fixed income is a safety net, this is where people get in trouble. And diversification goes much bigger than just bonds and stocks, or what types of stocks and equities. If it's volatile, variable, secondary tradable investments, you are still relying on a market that unfortunately can work against you. The income component of that portfolio is supposed to be income. And his point was, if that's the case, and this is the income they would normally produce, maybe an immediate annuity that just keeps pushing money, consistently for years into the portfolio would replace the bonds. That would allow you to then take the fixed income component and move it all into equities. Basically, the income component of the annuity becomes your bond portfolio. It was a very interesting way to look at it. But he made a great point, whether or not you do it that way or not. The issue is equities are supposed to help you keep up with inflation, but they can have, and equities or stocks and variable investments can have very, very difficult periods and long periods. And what is safe isn't always safe. So therefore, my big thing going into 2024 to pull this all together is divert, especially if you're going from accumulation to distribution, and for the first time in your life, or you already have gone to where you need to pay for things yourself, start to think about diversification in a different light. Start thinking about pulling stuff out of being subject to variable volatility. Start thinking about where you can get protected income, consistent income, and again, cash, because at the end of the day, access to capital is the only way you won't have financial stress.
Yeah, I think that's a great point. And access to bring up 2 points you said, Doug. Access to capital is a really important one, because interest rates have gone through the roof in comparison to where they were, right? And they were at 0, and now they're at 5, 5.25, and they're talking about lowering them. And mortgage rates went from 8.5 down to, I think, like 6 and change, 6.5. Forget what they are now. But that's a big drop. But it's still unaffordable, right? And people still, if you have to tap into that, and you're accustomed to getting, I don't know what the HELOCs were back then, but if you're accustomed to getting lower rates, and
1.5%, Kirk, at one point.
1.5. Okay, so you're accustomed to 1.5, now you're getting 6.5. That's a big deal. If you're accustomed to 10% on a credit card, and now you're getting 36, that's a big deal. And so access to capital, which traditionally, if you look at the biggest companies, I mean, I think Apple borrowed money at like less than 1% for like 20 years or some crazy thing in the peak. Like there were times where people were, I think there was, I forget which one it was, but there was an international company that got a 100-year bond, and his rates were so low, which I thought was crazy, but really smart, right? So if you think about access to capital, it's really important, especially in times like this, and you don't know it's a problem until it's a problem. So most people haven't experienced this. If I needed to borrow money, it's going to be really expensive. I'm not sure I want to borrow money, right? Which means, well, now I got to start spending less. Well, I'm going to start spending less. It means other companies aren't going to make as much money off me, which means they're going to start spending less. And round it goes. And this reinforcing cycle of inflation, deflation happens because of human behavior. So if we're talking about a setup here where we're going into the new year and we're trying to think about how we're going to prepare ourselves. This is a really important part of it, right? Access to cash, another important part of it, which we talked about in the interview. It's something that very few people think about, but it's something that everyone should have in their portfolio to some degree or another. You need to have access to cash. What if you need it? You're going to start selling your stocks after they're down 50%? Hopefully not, but you need to be prepared so that, you look at last year and Magnificent Seven did magnificent and most other things didn't do as well, but they still were decent, right? And crypto had a great year and gold had a decent year and small cap stocks had a great December. Like you look at all these things like, hey, everything's gonna be great. What if it isn't? How are you prepared for that? How are you, we talked about mindfulness in the interview, but mindfulness of where we are and where things could go, thinking that last year is going to be indicative of next year is an exercise of mindfulness. That's not how it works. Just because it happened in the past doesn't mean it's going to happen in the future, right? We have a tendency, a human cognitive bias, a tendency to extend what happened in the past well into the future, right? It's like, oh, we're running out of what was it back in the mid 2000s? I think everyone said, oh, is it Malthusian? We're going to run out of oil. Well, what happened? We didn't run out of oil. We found more. We created oil got too expensive. So technology was created to get cheaper oil. And what happened? We got cheaper oil and now it's cheap again, right? And if it happens again where we run out of that oil, they're going to come up with a new technology to make it cheaper again. Technology is the savior for a lot of these problems, but we tend to extend the present into the future forever. And that's not how it happens. So just be mindful of the fact that things are going to change. In the last 3 years, things have been up and down, but we ended the year close to the all-time highs, but we didn't hit them, but we were close there, what was it, a year and a half prior or 2 years prior? So it's not like it's new grounds. We were there before, but we bounced around for 2 years. Point being is mindfulness is really important in investing, and make sure that in anything you do in the new year that you're thinking, you're not just taking things for granted, that you're actually reflecting on and looking at and saying, what are the assumptions I'm making? Are they good assumptions or are they dangerous assumptions? The reason Warren Buffett has a record-setting amount of cash in Berkshire Hathaway is because he's not comfortable with valuations. He can't find anything to buy. And he's the first one to say, hey, if I could buy it, I would, even if it's an expensive market, because he buys it at such a price that it doesn't matter the market, he's still going to make money. But he's sitting on record amounts of cash because he can't find enough to buy. And that should trigger something in every single person to say, well, what does he know that I don't know? He's arguably the smartest investor of our era, and he knows something that I don't know. Am I smarter than Warren Buffett? I'm not saying you invest like him, but just be mindful of how these smart people are thinking, and are they acting differently than you? Then maybe you're missing something that they're seeing, and maybe you should reflect on that and come up with a different thesis. So as we kind of wrap up the show here, Barb, final thoughts from you on this wonderful topic.
Well, I think you want to combine both your psychology, your asset allocation, and your education. So if you are going to invest on your own, you need to get yourself educated a little. Jonathan Deyoe's book, Mindful Investing, is really very good. I've read it. He's a friend of mine. Plus, there are many other really good investing resources. The Elements of Investing is a 100-page Malkiel and Ellis that gives you the basics of investing. And this is for DIY investors. So I've said this pretty much on most shows. Know something before you deploy your money into the investment markets. Depending on your age, that will influence, and your comfort with risk, that'll influence the percentages that you have in the more volatile stock market, the less volatile bond market, or cash. And so understand that if you're young, you have a lot of time to make up losses. If you're getting older and into the withdrawal stages, you don't. So you want to own a little bit more of a conservative portfolio. So I am Barbara Friedberg. You can find me at Barbara Friedberg Personal Finance. See you next time.
Thanks for coming on, Barb. And one quick thought I forgot to mention before is in the concept of mindfulness is bonds. And in the last few years, we've had what is normally considered an inverse correlation between stocks and bonds has become a positive correlation between the two, which is dangerous if you assume asset allocation or diversification is going to work in the traditional sense. Not saying it's good or bad, just saying if you haven't revisited it, you could be setting yourself up for failure. So you should definitely revisit that this year, as the correlations have gotten to a point where it almost doesn't even make sense to have different diversification in the way that it's structured now. So just look into that in your own portfolio and make sure that you're doing it properly. Doug, final thoughts from you, and where can people find more about you?
Yeah, I think, one of the things you'll hear a lot is, people will say this time it's different, and a lot of people will push back and say this time it isn't different. Well, I would argue that when we think of things, we think of generations. They're kind of in 20-year cycles. And what I would say is this time it is different. We've been in extremely low interest rates for the past decade and a half. We have seen, we've seen an incredible shift in what is happening, where money is coming from. Technology has had influences and things on that. Interest rates have been low. Money's been accessible. It's not now. And for a lot of people, that is something they have never gone through in their entire career. So when they look back and you start to see the history and you start to see people talking about numbers and starting to talk about these allocations and these things work, the question you have to do is you have to go back and you have to look at the data. Kirk and I like to talk, this is more of a Kirk thing, but chart crimes, right? You start to see charts that will show you certain patterns of things. And then you just have to question, well, does that chart go back? What's the data before that showing you? How long is this pattern going along? When the conditions, and again, this is mindfulness, right? This is not looking at just general rules of thumb. Look through and actually understand the conditions we're in. What were the situations like, or what tended to be, what was around then, and how did that react to those conditions? What wasn't around then is going to be something that we're going to have to remain to be seen. Okay. And it's one of those things where, regardless of the situation, taking that emotion out of it's going to be critical. Barb talked about getting more conservative retirement. In a way that I believe that's true, in a way I believe it's not. Mathematically, actually, they've done calculations to say if you want to keep up with inflation, you should actually increase the amount of allocation to equities throughout retirement. Most people don't have the risk tolerance for that. But again, if you go back and build the right type of plan where you have access to cash flow, you have protected incomes, you have those things that allow you to get through those most volatile periods. Again, the farm analogy, you can arguably take the field, which is going to be what should be invested for the long run that you don't need for several years, and actually continue to be fairly aggressive in that to keep up with inflation. But again, if you take your composite as a whole and break down the pieces that you would use in the first couple of years, the cash that would, say, go in the silo, the more income producing that would go in the haystack. And if you have more questions about this, feel free to follow up with me. You could reach out to Kirk and get a hold of me there, or info@procollegeplanners.com. Be happy to talk to you more about this philosophy. But if you have that those broken down and put that as part of it, that will be your conservative part of the portfolio. And that's going to allow the rest of the stuff that you have invested to do its job. But even with that, be mindful of the conditions. Be mindful of the things that tend to work in those conditions and the things that don't. Be flexible, be tactical, and understand the difference between volatility and risk. Risk is the permanent loss of capital. And there are a lot of things right now that can influence what you're holding and make it years for that to recover again. Okay. And there's other things that are going to do well. And that's where professional help could be a guidance to you, because it is hard to do this on your own. And guess what? There's an old saying, doctors don't do surgery on their own family. Maybe that's a good argument as to why you shouldn't do portfolio surgery yourself. But that remains to be seen, and not everybody's going to want that help. Yeah, my name's Douglas Heagren. I gave you info@procollegeplanners.com. That's a place that you can find out more about what I do. I help families find money for college, get the cost down, and make sure that their children are going to have an extraordinary future. So again, if you've got kids, middle school to high school, planning for college, have some questions, reach out, download our free report, procollegeplanners.com.
Great. Thanks for coming on, Doug. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.